Hello traders, Kirk here from Tactical Options Trading. Welcome to the channel. When it comes to options, I frequently meet traders who are apprehensive about the risks associated with options trading. So today we're going to be confronting those fears head on by exploring vertical spreads, which is a tactical approach designed to mitigate risks and fortify your trading portfolio. Now, learning this strategy is fundamental and it serves as the foundation for understanding the more complex option spreads like iron condors, iron butterflies that you'll most surely encounter as you progress in your trading journey. So as we go over this video, pay close attention to the ins and the outs of vertical spreads. You may even want to watch this video several times to fully grasp the concept of vertical spreads, as it's going to be key to understanding the more complex option strategies. All right, so let's dive in. What exactly is a vertical spread? Well, in its simplest form, a vertical spread is the combination of a short option, one that you sold, and a long option, one that you bought at different strike prices in the same expiration cycle and on the same side of the options chain. For example, either all calls or all puts. So when you trade a vertical spread, you're effectively making one trade by simultaneously trading two options at the same time. Now, this collective trade is known as a vertical spread. So let me just say this here, that options can seem complicated, but remember this, that every options trade boils down to just 1 to 4 components. You're either buying a call, you're buying a put, you're selling a call, or you're selling a put. That's it. All options trade include at least one or all 4 of these elements. Now, when talking about a vertical spread, as I mentioned, they can be bought or sold, and they can be calls or puts. So let's start by discussing how to sell a vertical spread to open a trade. Now, in previous videos, we have talked about selling or shorting naked options to collect premium. In other words, selling an option to open a trade and then buying it back later as the value of that option decays to close the trade. As expiration approaches for those short options, if the option is out of the money, it will eventually become worthless. Essentially, we did the opposite of buy low and sell high. We sold high to open the trade and then collected that premium and then later bought it back at a lower price to close that trade. So let's consider an example of selling a naked option to open a trade in MasterCard. Now, MasterCard stock is trading at $448 a share, and we want to bet that it won't exceed $465 per share in the next 25 days. Well, you could just sell the 465 call option for $5.10, and if this option remained out of the money or is out of the money at expiration, meaning the stock is below that 465 strike, you as the option writer would keep the entire credit of $5.10 as profit. That is $5.10 or $510 per contract, as we know that each contract controls 100 shares of stock. Now, a side note, if you're new to options, the 465 call option in this example becomes worthless at expiration if it is out of the money, because why would a trader want to buy an option, or in other words, buy the right to purchase MasterCard stock at $465 if the stock were trading at $446 at expiration? Well, they wouldn't. They would just go out and buy the stock at the lower price of $446, so that 465 call option loses value as we approach the expiration and it is out of the money. So selling options premium sounds pretty awesome, right? Except there are a few issues that deter many options traders from just shorting naked options outright to collect the premium when opening these trades. So first and foremost, maximum risk is unknown, as MasterCard could rise well above that 465 strike, leaving you, the trader, with a huge loss. And theoretically, selling a naked call option comes with an unknown amount of risk. Now, when we're talking about naked options, naked meaning the writer, also known as the seller, does not own the underlying asset. This contrasts with a covered call where the writer owns the underlying asset and can deliver it if the option is exercised. Now, theoretically, selling a naked call option has unlimited risk to the upside, as the stock could technically go up indefinitely. Now, if the price of the underlying asset rises significantly above the strike price, the writer is obligated to sell the asset to the buyer at the agreed upon strike price. So since the writer does not own the asset, they must purchase it at the current market price, which could be much higher, leading to a potentially unlimited loss. Now, it's not often that we see markets crash up, but it can happen, and if you're not prepared, it could seriously damage you financially and blow up your small account. So many large investment firms have been ruined, and we've seen this by shorting or selling large naked call option positions without protection. So where does the risk come from? Well, it comes from the fact in this example that if you're short the 465 call, meaning you're obligated to sell stock at $465, and if the stock is now trading at $475, you're now on the hook for $10 per share because you need to deliver the stock stock to the buyer at $4.65. And if you don't own it, you must go out and buy it on the open market. And at what price are you going to be buying it at on the open market? You're going to be buying it at $475. So because one option contract controls 100 shares of stock, you would now be down $1,000 per contract if the $4.65 call expired $10 in the money. Again, unknown risk to the upside. Now, secondly, the capital requirement to sell this naked option could be substantial, as the broker will want you to hold a certain amount of margin in your account to make sure that you're good for it if you do have to purchase the stock. So back to our example of selling the MasterCard 465 strike. To address these two problems, unlimited risk to the upside and capital requirements, you could simultaneously buy the 470 strike call for that upside protection. So to open this trade, you would be selling the 465 strike call for $5.10, and then simultaneously taking $3.77 of that credit and buying the 470 strike call. Again, this is all considered as one trade, and the net difference would give you a net credit of $1.32 or $132 per contract. So buying this 470 call option does a couple of things for us here. Number one, your risk is now limited to the upside by having the 470 long option acting as insurance. Also, the capital requirement is reduced to the amount of the width of the spread. So in this case, it's a $5 wide spread, so it'd be $500 would be the capital requirement. Now, this combination of selling one option closer to the money and buying another option further out of the money in the same expiration series is called a credit spread. Now, a credit spread because you received a credit for opening up this trade. There are many names for this trade. I like to call these credit spreads because we received a credit for opening up that trade. And other names for this strategy are a short call spread or a bear call spread. Now, bear call getting its name from the bias that the trader has, and of course, the spread is traded on the call side. So let's look at another example of a call credit spread. Let's look at Meta. Meta is currently trading at $487 per share, and you believe that the stock will not rise above $535 by option expiration date of just over 32 days from now. So you decide to sell a call credit spread. So in constructing the spread, you sell a call option with a strike price of $535 and receive a premium of $12.15 or $1,215 per contract. And then simultaneously, you're going to buy a call option with a strike price of $540 and pay a premium of $10.97 or $1,097 per contract. So this results in a net credit received of $1.17 or $117 per contract. So let's break that down. You sold the $535 call and you received $12.15 in credit, then purchased the higher $540 call for $10.97, which leaves you a net credit of $1.17 per contract. So the maximum profit occurs if Meta stays below the $535 call at expiration, causing both options to expire worthless, allowing you to keep the net credit. Therefore, the maximum profit is $117 per contract. So let's talk about the losses in this trade. The maximum loss happens if Meta rises above the higher strike price of $540 at expiration. So the spread between the strike prices is $5, right? The difference between the $535 and the $540. And if both the $535 and the $540 are in the money at expiration, well, they're both going to have their full intrinsic value, and that would be a max loss of $5, which is the width of the spread. But since you already received $1.17 in net credit, your maximum loss is reduced to $3.83 per share, or $383 per contract. Now, it's important to know where our break-even points are on any trade. So to figure the break-even point on this Meta call credit spread, we take the price of the short call of $535 and we add the net credit that we received of $1.17, which comes to $536.17. So the stock could go up to and be at $536.17 at expiration, and you would not lose money on this trade. But what happens if at expiration the stock is sitting somewhere between the break-even price of $536.17 and $540? So let's say the stock was sitting at $5.38 at expiration. Well, the $535 call would be $3 in the money and would have its full intrinsic value of $3, while the $540 call would be out of the money and expire worthless, so you would have a loss on this trade of $3. But remember, you already received $1.17 in credit to open up this trade, so your loss on this trade in this example would be $3 minus the $1.17 in credit, which gives you a loss on this trade of $1.83 or $183 per contract. So in summary, for this call credit spread on Meta, you have a short call strike of $535, a long call strike of 540 for protection, and a net credit received of $1.17. So a maximum profit, of course, is only going to be what you were able to receive in credit, which is 117, with a break-even point of 536.17. So the maximum loss in this trade would be $383 if at expiration the stock were above that 540 call. Okay, a lot of numbers thrown out there, and as I mentioned in the beginning of this video, you may want to go back and rewatch this video a couple of times to understand these key points, as it's foundational to other option strategies. And I promise you guys that one day all this will just click in your mind, and before you know it, you'll be speaking options language fluently. It's like anything, right? You must practice, and then practice some more, and then practice some more. So hang in there, it'll come. All right, you ready for some more? Let's look at some examples on the put side of the options chain. Up until now, we've only talked about the call side, so let's take a look at the put side. The put credit spread is very similar to a call credit spread, but instead of having a bearish bias, a put credit spread has some bullish bias. And this is where I know a lot of new traders are going to say, wait, I thought puts were bearish and calls were bullish. And that is true if you're buying them to open trades, but we are net selling them to open these trades, so they are reversed. I know. It'll all make sense to you the more of these that you do. So, all right, here we go. Let's take a look at Google. Now, Google is sitting at support, and it looks poised to move higher. And of course, no one knows which way the stock's going to move, right? But let's just say that we think that the stock is going to move higher. So we want to formulate a bullish trade in Google. So let's sell a put credit spread. So another name for this trade is the short put spread or bull put spread. Bull put spread because we are bullish and selling puts to open up this trade. As we are looking at the chart here, I've already drawn some lines to show you where our put spread will be sitting in relation to the stock. So the red line here will be our short put, and our green line will be our long protective put, and the line out here is expiration. So let's jump into the options chain to set this up. So we're going to be selling the 175 put, and simultaneously we're going to buy the lower 170 put for $1.54 in credit. So in this example, we want Google to stay above the 175 short put at expiration, and the same concepts apply here. We have a $5 wide spread, which is the difference between the 175 and the 170 puts, and we are receiving $1.54 in credit to open up this trade. So our max loss would be $5 minus $1.54, and that would give us a max loss of $3.46 per contract, or $346 per contract. So our break-even point on this trade is what? So to figure this out, we take the short put strike and we subtract the credit received to give us the break-even stock price. So we take the 175 put and we subtract $1.54, and that gives us a break-even point of $173.46. So the stock could be down at $173.46 at expiration, and we would break even. So it's always important to know where that break-even point is on any trade. Again, what I love about trading this strategy is that our max loss is already calculated before we even enter this trade. So in this video, we're not going to go into the strike price selection as I've discussed it in other videos, but we generally shoot for the short strike to be at the 30 delta. But knowing your max risk and having it defined will make you a better trader, and it'll allow you to stay in that trade longer because of that risk. It's defined. And of course, on all these trades, we want those probabilities to play out. So no need to put a stop loss order on any of these trades as our risk is already defined. So just let that trade work. You know, I always say this, but putting a stop loss order on a defined risk trade is like adding a stop to a stop. Your risk is already defined. How many times have you been stopped out with a stop order just to watch the trade go in your desired direction? That's the beauty of a credit spread. You can let the trade work and let the probabilities work out in your favor because our risk is already defined. All right, guys, that's going to wrap it up here. If you found this video helpful, you know what to do. And don't forget to subscribe to Tactical Options Trading for more trading content. And make sure you click that bell icon so that you get notified whenever we post a new video. Also, check out these other videos to help you on your trading journey. Also, grab a copy of my free options trading ebook in the description. I promise you guys, you'll not be disappointed. Thank you so much for watching, and happy trading.